personal finance is more personal than it is financial.
Very true.
And so our job is more like we're partners with our clients, but we're also counselors. I remember in 2022, the worst year since 2008. From January 1 to September, the market was just tanking. But I remember talking to a current client, and I remember getting a message from him saying, hey, I want to go more conservative. And I'm thinking, he's 46 years old. You don't want to go more conservative at the bottom. And I remember just giving him a few statistics that he wanted to look at, like the fact that since 1950, after a midterm election, the market rallies. Don't let fear drive this decision. Let's wait till December or January, and then let's get more conservative.
Sure.
Well, then what happened? It didn't even wait till the midterm election. October, the market soared.
All right, today should be a fun episode, Robert. We get to talk about market indexes.
I was thinking because it's close to the weekend and I get to be here with you, but I'll take that. That should be a fun topic.
Well, you're welcome.
Yeah, thanks.
So let's talk about when clients or potential clients or just people out there, listeners, they think about the markets, right? They look at a particular index and they go, hey, the index is up X. Shouldn't my portfolio be up Y or X plus Y?
Well, I think it's a common misconception that people have where they think my portfolio needs to keep up with an index. My first question would be, and you can answer this one, what index?
Sure.
There's more than 20, nearly 30 major.
S&P, Dow Jones, Russell 2000, NASDAQ.
If you Google indexes, you'll see thousands of them, but there's almost 30 major indices. So which one are we going to follow? Which one are we talking about today?
I think S&P 500 most people are familiar with.
Most people's that's the most common one. Yeah. Okay, so what does the S&P 500 represent?
500 largest U.S. stocks.
Okay, so it doesn't have small cap.
Correct.
Mid cap, international, bond markets, MSCI, emerging. None of that?
That's right.
So if I want a diversified portfolio and I'm focused on risk, then comparing myself to a 100% equity index that follows only one sector, I could be setting myself up for failure, right?
Okay, I see you.
And then are people going to be comfortable with the risk? Most people aren't comfortable with losing 30, 40, even 50% drops just by tracking an index. But what I would tell you is if you're okay with losing that much, you're okay with your portfolio possibly cutting in half, and goals, you're not necessarily focused on long-term goals, and you just want to track the S&P, then go buy an S&P index. I mean, that's fine. For many people, that's not what they want, but for that 1 or 2% out there that they're just concerned about an in particular index, go buy that index, but be okay with it.
So if somebody wants to achieve the rate of return of the Dow or the S&P 500, if I'm hearing what you're saying, and are comfortable with maybe losing 20, 30, or 50%. Sometimes that happens. Not all the time, but it happens. They should do that. Now, I think I would add, I think you would agree, it kind of depends on what stage of life you're in, right? If you're 20, 30, 40, 50 years old, if you're invested that way and the market, even if it did drop 50%, you're going to be fine, most likely, right? If you're not retired, that's why I threw those ages out. If you're not retired, you're not needing the income, and even better if you're still saving, because then you can dollar cost average as the market comes down. That makes sense. But I think the game changes when we call it a red zone. If you're 5 years from retirement or 5 years into retirement, and your portfolio drops 50%, that's a problem because now you're selling. You're doing the inverse of dollar cost average, and you're selling at the bottom instead of buying at the bottom.
And that's why a lot of times it doesn't work well for them. What worked well in your 20s and 30s may not work well as we get older and we actually accumulate that wealth. Sure. You can't afford in those catastrophic years to have losses like that. You went from an accumulation phase of most of your life, getting closer if it's 5 years leading up to retirement or you're already in retirement. You went from an accumulation phase to a distribution phase. And it is more important, and we've talked about this in the past, to lose less than the market in those negative years than it is to make as much in the positive years. In fact, chasing a rally could be detrimental if you're catching all of the losses. 2022 was a great example. Many people do not realize that 2022 was the worst year since 2008. And since we're talking about the S&P, let's stick on that because many indexes lost different amounts this year. But the S&P was down 20% in 2022. So if you're in the S&P and it lost 20% in 2022, it went down to 800,000 if you started with $1 million.
You lost a fifth of it, yeah.
But if you made 20% the next year, are you back to $1 million?
No, you're still down.
You have to make 25% to get back to that million. So what did the S&P do? It lost 20% in 2022, and then in 2023, it made 22%. That's right. So for an average rate of return, it looked like it was positive. It wasn't. It actually didn't get back to its break even until March of 2024. So losing less is more important than trying to capture everything on the upside. If you can lose less in the market, you can leave some on the table during those up years, and you're going to be ahead.
So I think because it's so important, is what I'm hearing from you, to minimize the downside, right? You want to capture as much of the upside as possible, but maybe you leave a little bit of the gain on there because you're reducing your risk. What I'm hearing you say is you probably want to be, even if you're an index fund, if you're a do-it-yourself, or you probably want to have different index funds, right?
Yeah, you want to be diversified.
Not just the S&P 500.
Yeah, I mean, when you think about it, what are bonds? And those are kind of like your breaks, right? So when the market, the inevitable swings that we're going to get, the inevitable corrections that you're going to get on average every 14 to 18 months, if you don't have any powder dry, then you're just riding the market. If you go back more than 100 years, one of the smartest philosophies to do in investing is when the market's up, take some chips off the table. When it's down, put those chips back in. It sounds simple enough, but when it comes to emotions and it comes to riding the market, people don't think like that. They let emotions drive that decision and they get caught up. But if you're following just an equity index and you have 100% of your assets in it, you also don't have any powder dry to take advantage of those dips.
I was about to ask you that. So when it comes to stocks, does it make sense? And what's the downside if somebody has 100% of their money in stocks, whether it's in one sector, or just even if it's diversified, but it's 100% stocks? What are the pros and cons of that?
The pros is that long term you'll just track the index that you want to follow, and whatever their average returns are, that's what you're going to make. That would be the pros. The cons is you're not diversified. Let me ask you a question: if we're following the S&P, has the Dow ever beat the S&P up or down?
Yeah. Yep.
Has the Nasdaq ever beat the S&P?
Yep.
The Russell 2000?
Yep.
The bond market?
Yep.
All major 5 U.S. indexes that we look at, in any given year, one can beat the other.
That's right.
So why are we focused on the S&P? When we build financial plans or meet with people and build financial plans for them, we focus on the long-term goals. Why risk money you need to make money you don't need? For the 95+% people out there that are going for long-term goals, most people can't afford to have those big swings or those catastrophic losses. So they don't need to be in a 100% equity model. Now, could you be leaving money on the table at times if you're not in a 100% equity model? Yeah, maybe in the short term, but it's all about long-term planning. It's all about missing the catastrophic losses and not chasing the rally.
What do you think in that regards? What do you think the biggest mistake people can make here?
Comparing their diversified portfolio to a single index, because a single index is not diversified. So again, it goes back to planning. They have to understand what they're trying to chase and not let fear drive a decision. What happens a lot of times is emotions, right? The market's up, so people go, oh, I'm missing out. I need to be in more equity. So what are they doing? They're chasing the market. If you're chasing something,
FOMO.
Yeah, if you're chasing something, you're behind it.
Yeah.
So it's up. They go, I got to get more aggressive. And then what happens? That inevitable correction we talked about, where you get that 7, 15%, sometimes even 20% dip. And so they're buying up here, and then they get the dip, and then what happens? The fear again. The fear again kicks in. The fear of...
And they sell at the bottom.
And they sell at the bottom. And then what happens? So it's literally the opposite of what your mind tells you should do. Yeah. But when you're immersed in the emotions and the fear, then you make dumb decisions. It's like when they tell you, don't go gambling with your rent money. You know, the people who win at the casinos that you always hear about winning, they went prepared to lose, and then they won. because they went with more of a statistical or tactical measure. The people that have the rent money and go, I need this. I can't afford to lose this. What happens? All logic goes out the window, and they end up losing it all. Fear controls everything, and in the stock market, you can't let fear drive that decision. Why is it that the stock market and casinos, things like that, why is it the only thing that we get emotional about? Think about this. Let's say you like steak. Let's say you're a steak eater, and you go to the store, whatever store you like. I know you pick on me about Whole Foods, but let's just say it's Tom Thumb or one of those. You go to steak.
I shop at Walmart.
Okay,
it's
you're
okay
at Walmart.
To shop at Whole Foods.
You're at Walmart getting your all natural, all grass-fed beef steaks.
That's right. And
you go one day, and your favorite steak is the price is cut in half. Do you buy more?
If it hasn't expired, yeah.
Well, that's a good point. So it hasn't expired. They're just putting
and will expire tomorrow before I eat it.
They're putting on a deal. So you got plenty of time before expiration. They have it on sale. Would you buy more?
Sure.
What about if that same steak doubled in price? Would you buy more, or would you buy the same amount that you normally buy?
Supply and demand, right? You're probably going to, in theory, buy less or not buy it. Yeah, I know where you're going, but don't want to.
So why is the stock market the only thing that when it's up, people decide they want to throw more money at it?
Sure.
And when it's down, they're too fearful to get into it. They're following what the news is saying, but what they don't realize, I think they realize, but they don't care to admit during that time, is the news gets their ratings by selling fear, not rainbows and butterflies. You're not going to watch that. We get hooked to what's going on in the down times. So fear controls a lot, and it shouldn't. You have to use, and I'll tell you one more story. Let's go back to COVID, right? Yeah. In March of 2020, the market started hitting. The United States is shutting down. I mean, I remember we were sitting there, and we're human, right? I know there were times that we went home with knots in our stomach going, I hope tomorrow's going to be okay. I hope a month from now is going to be okay. And I remember us having those conversations of, do we do this? Do we do that? And it came down to do what's worked over time. Tomorrow the sun is going to rise. The market's going to open. And so this is a buying opportunity because this too shall pass. So what did we do? We started just dropping money back into it. 2% here, 3% here. Getting in at those lows because we didn't know where the bottom was. Nobody did. And anybody that tells you they did, they're wrong. But you started buying. Well, then what happened 4 or 5 months later? The market was roaring back. But we met people that sold out at that bottom because fear made them do something they shouldn't have done. They threw all common sense out the window, and they were moved by fear.
Yeah, fear and greed. You want to be greedy when others are fearful when others are greedy. It reminds me, here we're always hiring financial advisors to bring on staff, and typically the newer ones, the younger ones, whenever the market pulls back, this has happened to me, I don't know, 4 times maybe, the newer advisors who are in their early 20s, it's their first rodeo in terms of helping a client in a time where the market just dropped 20%, 25%. And in our weekly meetings, they'll be like, well, what do we do if a client wants to go to cash? Or if they do, how do we go? Or maybe not cash, but they want to go more conservative, right? Somebody is in an 80% stock portfolio. The market's down 20%. Maybe they're down 10, depending on the model. But the client wants to go more conservative and sell stocks, a portion of it, after it's gone down. And what I always tell them, man, if somebody wants to sell stocks and it's not because they need the money, that's a different scenario. They're not retiring, but it's purely because the market's dropped. You, the financial advisor, are not doing your job. If you cannot persuade them and get them to understand why that doesn't make sense to sell after the market's dropped, that's a problem. These conversations, they have to happen in the good times, right? You want to determine, should I take less risk when everything's great? After last couple of years, the market's been over 20% each of the last 2 years. And 2025, it hasn't been a bad year either. We're annualizing over 10. This is the time to decide, okay, do I want to take less risk? Don't wait for September, October, November. Let's say the Fed doesn't drop interest rates and the market comes down 20%, and then you wake up and decide, hey, I want to take less risk. You want to do all of that thinking and decision making when the odds are in your favor, when the stack's in your favor, and that is when the market's up.
Yeah.
Right?
It reminds me of the story when we talk to the new advisors and or the young advisors. Maybe they've been in the game for a while, but this their first down market they're experiencing, and we always have to remind them that personal finance is more personal than it is financial.
Very true.
And so our job is more like we're partners with our clients, but we're also counselors. Our job is to educate them on historical trends. And as you like to say, history doesn't always repeat itself, but it sometimes rhymes. And while you were talking, it made me think of, people that normally wouldn't freak out. I remember in 2022, the worst year since 2008. And the year finished off bad, but that wasn't actually the worst part of the year. From January 1 to September, the market was just tanking. Now, it had a nice little rebound that fourth quarter, but I remember talking to a current client. He's, at the time, 46, 47 years old. Got a few $1,000,000. His plan's on track, so he can afford to take less risk.
So he's on track to retire when he wants.
On track to retire, right.
Okay.
And he wanted to retire early. He wanted to retire at 55. Good for him.
Okay.
But everything looked good. And I remember getting a message from him saying, hey, I want to go more conservative. And I'm thinking, he's 46 years old. You don't want to go more conservative at the bottom. So I immediately pick up the phone and I call him, and we can't say a name, but I call him and I go, no, you don't. And he goes, I just, I don't trust this. I think it's going to go down further. And I remember just giving him a few statistics that he wanted to look at, like the fact that since 1950, so this is 2022, 1950, nearly 100% of the time since 1950, after a midterm election, the market rallies. We're in September. We're a month and a half away from a midterm election, right? And so I go, hold tight. If you want to get more conservative, don't let fear drive this decision. Let's wait till December or January, and then let's get more conservative.
Sure.
Well, then what happened? It didn't even wait till the midterm election.
Rebound.
October, the market soared. And I can't remember, it was like 16, 17, 18% from the bottom of September to the end of the year, right? It was crazy. For him, that was a $500,000 decision. I remember getting a message from him in December going, thank you, Robert. You saved me. And I go, it's not our job to just make trades or just to be order takers when we want to be. It's our job to help educate and to let you see through clear lenses. And for him, that's what he needed. And he loved it. He's still thinking today. But then I called him because I wanted to play devil's advocate here and go, now let's go more conservative. So in that call, I'm like, hey, thanks for giving the compliment. We don't get paid to make trades. We're fee-only fiduciaries. We get paid to manage money. So I go, now if you want to go more conservative, now let's do it. Of course, what do you think he said then?
Now he wants to be more aggressive. Right?
Why? Because the market's hot, right?
It's emotional.
It's all about following the plan.
So as we wrap up this episode, we're talking about the indexes, why it may not matter, right? That you're outperforming or matching. It may. Again, it depends on how old you are, I would argue. And the reason how old you are matters is when you're going to need the money, how far you are from retirement or a cash flow need from the investments, what your appetite for risk is. So some people out there, you're 5, I would say, actually, I'd probably say 10 years away plus from retirement, and you have an appetite for a 50% drop. Yeah, go ahead in the S&P 500 or one of these. Again, if you're comfortable with a 50% drop and you don't need it for 10 years. Other than that, you might want to look at some analysis on what the ramifications are. If you have a cash flow need in 3 years and a market drop 50%, how that's going to impact all that. Wrap the show up for us. What else do you want our listeners to know, Robert?
I would say, to your point, if all you care about is matching an index, go get in that index. But don't forget about the important things. What does retirement look like for you? If retirement's not a goal for you, if leaving a legacy is not a goal for you, fine, do an index. But for most people, not all people, but for most, having a financial plan, understanding downside risk, not capturing all of the downside is important to them. But let's take it a step further. What about tax strategies? Healthcare and retirement, Social Security, Roth conversions, estate and legacy planning. If you don't have a plan put in place that understands the risk of the market and is well diversified and allows you to capture a mixture of different indices, you're setting yourself up for failure, or could be. So the biggest takeaway is have a plan, work with an active manager that understands your needs, understands your risk tolerance, understands your goals, and invest appropriately.
Okay, great. Well, we get to do the mailbag, Robert. So you ready for the question of the day?
I am.
It's not addressed to you, but you're going to get to answer it.
All right.
Comes straight from Molly.
Molly.
You know her?
Hey, Molly. I've known a Molly.
Okay.
I don't know if it's the same Molly.
How often? Hi, Robert. She didn't say that, but how often?
Hi, Molly.
How often should I rebalance my portfolio?
Oh, that's a good one. I think it just kind of depends, right? I mean, I know the generic answer that many people will give you is rebalance every quarter or put your 401k on an auto rebalance for every quarter. I mean, that's a good generic answer, but it just depends. If you want to be an active manager of your portfolio, if you're a do-it-yourselfer, then, and you've got the time, then look every day and decide as one stock gets up or one sector of the market gets up, you can rebalance actively. Not many people
one
have.
sector goes up, one goes down, maybe sell some of the winners and buy some of the losers.
If you have the time for it.
Yeah.
But not everybody has the time to look at it every day because they do have full-time jobs, or they're taking care of family, or they're taking care of kids and grandkids.
So what I'm hearing you say is if you have an advisor, like what we do, we're managing it daily, right?
Yeah.
So if a listener out there has an advisor, their advisor should be looking at it daily and seeing when it makes sense. Might make sense quarterly. They may not touch it for 6 months if it's still in alignment. But for your do-it-yourselfers, let's say somebody doesn't want to work with an advisor, they're just doing it themselves and they want something kind of low maintenance, quarterly, that should suffice to get it rebalanced and in the correct allocation?
Yeah, I would say so. And I think most people don't want things on autopilot. So I like active management, and I think most people do too. And there's years like 2019 that the market was just on fire. Everything was up.
Yep.
So would I rebalance every quarter? Not necessarily, because that could make
That could hurt your performance.
It would hurt performance, but then it could give you taxation, right? You could be realizing taxation that you might not need to. And depending on how long you've held that position, you could be doubling your taxes by recognizing short-term gains versus long-term gains. And we could, of course, do a podcast on that one day. But so there's years that maybe you don't do as many rebalances. But I would tell you that the more volatile the market, we were just talking about 2022 being the most volatile year, the worst year since 2008.
Sure.
Well, there was a lot of rebalancing going on because that volatility creates opportunity for active managers to take advantage of. So if it's on kind of autopilot, you may be missing the boat. And for some people, maybe that's okay. But for the majority of people, they want to take advantage of that.
Okay. And then I guess the last thing I would add is it depends on what type of account, right? To your point, the taxation. If it's taxable, that makes sense. But if it's an IRA, a tax deferred account, IRA, 401k, that's not going to be an issue. It might make sense to rebalance more frequently. Again, emphasis on might, because an example you gave, if the market's going up, yes, there's no taxes if you make it more conservative, but it might not make sense to sell those winners and buy losers if the market's on a prolonged bull market.
100%. Right? I hope that helps.
I think Molly will be truly appreciative for your wisdom there, Robert.
You answered a lot more of it, so I appreciate you.
Well, thank you, everybody, for listening. Feel free to share this episode. Anybody out there who maybe is a do-it-yourselfer or is in indexes, the pros and the cons. I know some advisors always say it's a bad thing. No, you have to work with an advisor. I disagree. Some people don't need to work with an advisor if they're comfortable with the pros and cons of index investing and what comes along with that. Thank you, everybody. Thank you, everybody, for listening. If you have any friends or yourself, maybe yourself, that doesn't make sense. Share this with yourself.
If you have friends, share it with them. If you don't have friends, watch it again with your pet.
If you have friends, share it. If not, keep watching it. I'll be your friend.